And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. A diverse show today. We'll be talking about tech trends, the search for yield in ETFs, and commodity trends as well. But first, tech ETFs down big this year, but investors are not fleeing. Why not? Let's talk to Anna Paglia. She's the global head of ETFs and index strategies at Invesco. Dave Noddick, my old buddy, financial futurist at VettaFi, here as well. Anna, you run the largest tech ETF that's out there, the triple Qs. We talk about it all the time. It's the NASDAQ 100. We're down 31% this year, and yet I see no outflows. Shares outstanding are near 17-year highs, and S&P tech sector, Kathy Wood's ARK fund, not appreciable outflows so far this year. Why are tech investors so loyal to the markets? Why aren't they fleeing?
Well, they are not loyal to the market. They are loyal to the idea of growth. You do not assess growth companies based on what's happening today, what's going to happen next month. You assess growth on what you think is going to happen in the next 5 years or 10 years. So you have to look at the entire cycle, and I'm not surprised to see so much loyalty on the QQQ. We actually piled on the QQQ with new products over the last few years because of that.
I want to talk about that, but Dave, I look at these leverage and inverse bets on the triple Q. It's a gigantic industry.
Highest volumes every day.
Yeah. Every day, these ProShares Ultra Pro, ProShares Ultra Short QQQs, the biggest thing. Why is that? How are they used? And given the reset every day, I'm amazed at the success of them.
I mean, it's speculation, right? And I think we have to put two things together. One is that the Qs have been used as the proxy for tech growth in the United States since the 90s, and that has only become stronger over time. So when people look at the shorter, the leveraged versions of that, what they're really doing is using the benchmark proxy for tech and growth in their day trading strategies, right? We talk about SPY being a proxy for sort of generic large cap and all of the derivatives activity that happens around that. In the Qs, while there's a little bit less activity in some of the more obscure derivatives markets, in the ETF space, boy, those short and leveraged products have just been stalwarts for volume ever since they launched.
Yeah, you know, Anna, we have talked, Dave and I have spoken often about the increased complexification, if you want to call it that, of the ETF structure. Have ETFs gone too far with these leveraged and inverse products? I mean, you run a big family of funds. What's your opinion on this?
So, Bob, you can call me old school here. I'm a purist. I believe that ETFs should deliver the results that investors expect from them. And if you think about ETFs, the first thing that comes to mind is ease of access, diversification, cost effectiveness, and efficiency. Now, if you take that away and you add the level of complexity, now you are directing your offering to a subset of the population that is not really buying ETFs for diversification and ease of access. So I am a purist. When you think about ETFs, I like the traditional diversified portfolio.
Can you make an argument for why we need these? I always say that leverage and inverse are 2% of the volume, 98% of the problems.
Clearly, the headlines.
Do we need? Is there an argument to be made that why we need them?
Yeah, absolutely. And we can turn to the Qs as a perfect example here. The people who are trading short Qs and leveraged Qs are not doing that because they're looking for a more efficient beta for their retirement plan. They're doing that because they're making a call on tech earnings season, one way or the other. Maybe even tech earnings announcements today. That's where those products have a real place. Now, is that investors? No. Those are speculators and day traders looking to put large amounts of money to work quickly in a well-tracking, highly liquid vehicle. ETFs really do check that box. Now, I agree this is not really where ETFs have found their foothold, which is really with buy and hold long-term investors and advisors. But there is a market for these more traded tools. Now, whether they should be as accessible and whether there should be gates against some of those sharper tools, I think that's a reasonable conversation.
Gensler's talked about the idea of should people be required to have exams, for example, for these complex products. And there's something to be said about that. I mean, you do have to sign off saying you understand the risks of trading options,
yeah,
right? Well, any miner could buy ETFs. I'm exaggerating, but
no,
it
but
does hide the risk.
It's not that wrong. Like my mom and her, IRA can go buy triple leveraged oil if she really wants it.
Yeah.
Should she be able to without acknowledging she understands those risks? Probably not.
Yeah, and Bob, this is why it's so scary, because there is a derivatives market that exists just for that type of investment, those sophisticated investors have access to the derivatives market. So should they have easy access through an ETF?
Right.
That's a different type of investor that maybe don't really want.
I can imagine a guy who wants to trade options, and day trade, saying, well, hey, this is fabulous. I don't have to have a margin account. I don't have to do anything with an ETF. It's sort of a backdoor way of getting what they want without having, to put up.
And on the short side, you never have to worry about getting a margin call because all you can lose is all your money, which always strikes me as an odd selling point.
Yeah, it is. It is a great way to say it. Anna, these triple Q products have done very well. You had the next generation 100 ETF that launched a couple years ago. I call it the NASDAQ 200. But it's sort of the 100 non-financial stocks that are next eligible for the 100. I guess that's the way to say it. I call it the NASDAQ 200, essentially. There's been some modest outflows this year, but considering these companies tend to support relatively high valuations, it's still a lot of loyalty from investors, even in what you could call arguably the second tier of tech companies that are out there.
Indeed. So 2 years ago, Bob, you may recall that we launched an innovation suite. So we created the 40-act version of the QQQ and the QQQJ, which is the next generation of QQQ, NASDAQ-listed companies. In the last 2 years, these products have collected something like $6 billion of net new assets. And that really shows the investor loyalty to this type of concept. And we just launched a third addition to the family, QQQS, S for small cap, that gives investor access to the entire journey of a growth company.
Yeah, the distinction here with the Cathie Wood's ARK fund may be that most of these companies do make money in the NASDAQ 200, even if they have high valuations that are out there. So I'm just astonished at how loyal everybody seems to be.
There is an index methodology, and I think that gives people some solace, right? They know that they're not going to have to worry about whether this is in or out tomorrow because there's a methodology, and that tends to smooth out that ride. It's not surprising to me with the franchise that the Qs has in terms of a brand that people are trusting that brand to look further into the market. So it doesn't surprise me at all.
Yeah, so I want to talk about your new product here. You've got a new QQQ. There's a whole suite of products they're launching around this thing. QQQS, you mentioned. This tracks an equal weight of 200 NASDAQ stocks based on the value of patent portfolios. Here's a very interesting concept, and yet the way you keep explaining it to me is the patent's at the heart of why famous companies have been successful in the past. Explain what this is about now.
Sure. So if you put the concept of innovation to work, we look at how much money companies spend in research and development. And the money in research and development translates into patent filings. Now, if you go back in time and think about the big tech companies, or even outside of tech, think about Amazon, think about Tesla. These are companies that invested a significant amount of assets in research and development. Amazon 10 years ago, 15 years ago, was the place where you could buy books online. Today is much more than that because of all the developments in tech. Tesla, if this fund existed in 2011, Tesla would have been in the fund back in 2011. And we know that Tesla has been promoted into the big QQQ. So for us, patents are an indication of innovation, and QQQS, which includes small cap tech companies, give access to that growth journey that translates into the J and into the M.
This makes some sense, what you're saying. I look at the companies on this list. They're small. Prothena, Fibrogen, Seres Therapeutics, Paratech Pharmaceuticals. But I can see how all of them are going to depend on some kind of patent to make their bones.
This is a page right out of the active management playbook from the 90s and 2000s, right? Going after companies with strong intellectual property has been catnip for active investors, stock pickers, for a long time. This is taking that with a systematic approach. Right? We have so much better data than we had 20 years ago, not just about what patents have been filed by what companies, but on how to value those patents, how they match against other things in the market, how unique and marketable they are. All that can now bake into a methodology that on the surface looks very simple, but is actually covering up what was 30 or 40 years of active management prowess, really trying to understand what companies were building.
It really highlights the wonderfulness of ETFs because the methodology enables you, and you're listing some of the companies here, to essentially troll for the companies that have valuable patents, put it into an ETF. So what would have taken a big research team and a mutual fund that would have charged you 2% 20 years ago, you now buy in an ETF. Another advertisement for the ETF business. I want to just...
simple and rule-based.
That's
and
right.
predictable.
Rule-based. Good idea. Good point there. I want to. I know we've been talking about tech a lot. I want to move on to another hot topic, and that's the search for yields. We've been doing this several times. Invesco, Anna runs Invesco. Okay, the ETF end of Invesco. Senior loan ETF, BKLN. This is tracks a market value weighted index of senior bank loans. These are issued by banks to corporations most of the time. After seeing a good outflow for part of 2022, we're seeing inflows. What do we have, a 3.7% yield here? That's got to be part of it. But what's the attraction here? What are you getting with a bank loan, first off, and how is it different than, say, a treasury bond? Explain it to somebody.
Sure. So BKLN gives you access to the 100 most liquid loans that are offered in the marketplace. And that's powerful because when you think about the loans, the first concern that you have is about liquidity. Now, this fund really wraps the most liquid loans. The yields are in excess of 3% now, so we have seen incredibly healthy flows from clients looking for income, looking for yield, and those clients that are worried about inflation, interest rate hikes. So we have seen outflows at the beginning of the year, which have turned around in the summer, and now it seems like clients are really looking at the yield story, and this fund is the perfect vehicle for them.
And maturities for these loans are typically what range? 5 years, 6 years, 7 years?
Yeah, fairly short, often with a variable interest component as well, so they can give you a yield that you might not just expect to see if you look at liquid corporate bonds, right? It is a different structure of financing, but this hunt for yield, it's up and down the product line. We've seen flows into traditional short-term bond funds, but we've also seen a lot of interest, I know, in your bullet shares products, particularly in the corporate side. Some of those that are, have a yield to maturity of only a couple years now are paying 5, 6, 7% on the high yield versions.
All right.
That's catnip, right? That's for an advisor that's been hunting for yield for the last 7 or 8 years, being able to see a 5, 6, 7 handle on a potential yield for a short-term bond fund seems insane.
Even a big uptick in ultra-short duration.
Yeah, well, absolutely. And the ultra short side is probably more of a cash management issue, right? Yeah. We've seen, I think, in this downturn, instead of a huge increase in money market mutual fund and cash sweep vehicles, we've seen a huge increase in super short-term bond funds up and down the spectrum.
So super short for you is 1 to 3 months?
Yeah, 1 to 3 months, under 6 months, right? You get out towards 6 months, and now you're talking about products that are really more like actively managed short income funds.
Yeah. So what we have here, Dave, suddenly we've got a whole raft of products which have real yield now. That's quite amazing. I mean, how do you think about that in your bond allocation?
Well, I think there's some really interesting stuff going on in the sort of portfolio management academic sphere around, do we now need to rethink what we meant by the efficient markets hypothesis, right? Do we believe a 7% yield when we're also pairing that with, say, 7, 8, 9% inflation and what we know is going on in the capital structure inside companies? I think a lot of those pieces are moving parts. You talk to very sophisticated advisors who run model portfolios, and they're not claiming they have this all figured out either. They're really trying to understand all of these new betas that are coming to market and how they're really going to interact in the rate environment that we can project for the next year or two.
Yeah. So I guess the question is, I'm trying to give practical advice to viewers who are watching here. Where does it fit in your portfolio? We had the fellow who was doing single bond ETFs last week on. I mean, viewers literally wrote in and said, this 4.2% on the 4-year, on the 2-year, where do I get this? Because on my bond funds, I don't have it. And I said, well, that's the problem with bond funds. They own old bonds.
Right.
So here these guys, they do an on-the-run
right.
Bond. They literally sell auctions are every month. They sell the last auction, buy the new one.
And it turns out to be cheaper than doing it at Treasury Direct.
Well, that's what really they claim.
It really does.
Well, they say that. I don't know.
I've talked to a lot of advisors who are using those types of products, and the reason they have traction is because most advisors can't log into Treasury Direct and go buy 400 bonds for their 400 clients. They have to go through a desk somewhere. The friction in that desk ends up being more than the cost of just buying one of these cheaper beta funds.
Yeah. Commodities continue to be a big diversifier out there, whether you're owning commodity stocks or a basket of commodity futures. DBB, for example, this is one of the favorites out there. It's basically copper and aluminum futures, I think. Or DBA, this is the agricultural futures contract.
Or PDBC.
So we've seen geopolitics cause price fluctuations in agriculture this year. Look what's going on with the Russia-Ukraine and how that's messing with wheat. Industrial metals are being driven up by potential bans on aluminum, drawdowns in copper. It's been a crazy year for that. How are these funds trading?
Well, the commodities, I mean, let's look at the asset class to begin with. Commodities have been performing much better than equity and bonds, which it's obvious. It has been obvious throughout the entire year, even if during the summer they gave up some of the upside. We have seen very healthy flows in products like PDBC. You know, Bob, when you think about commodities, you think about precious metals, gold, but PDBC offers a diversified portfolio, which is what investors really like. So you will find in there energy, but also agriculture, industrial metals. So you have access to a portfolio of commodities that is very diversified.
No, I want you to explain the title here, because it's optimum yield is the PDBC. What is it?
Correct.
What does optimum yield mean? How do you?
So it's based on an index methodology that really selects the best yielding contract at the end of the month. So it doesn't go necessarily from month to month. This fund invests in futures, so let's not forget that. So the secret behind this portfolio really stands behind the optimal yield methodology that is not just rolling a future from month to month. So we look at the value for our investors in how these future contracts trade.
Is there indications that investing, this is a managed fund in a sense, that I mean, it's a rules-based fund, but is there evidence that that would be a superior way than just mechanically rolling over, okay, we got 6% in copper and 12%?
You can do the math in your head, right? If the futures curve for oil is like this, you don't want to be rolling into that contango month after month. It's going to cost you, right? So somewhere that curve rolls over where it's still sensitive enough to the price of oil, but you're no longer paying a 2 or 3 or 4% monthly cost to keep rolling. That methodology basically finds that spot on the curve where you're either making money from backwardation or you're minimizing the loss from contango. It's been out for ages, and that methodology has been out for ages and ages, and it's been very successful. It's absolutely the default for most financial advisors, PDBC.
So that's a very good example then of an actively managed rules-based fund where it actually changes month by month, right? So at one point, you might have a certain amount of money in oil futures, and the next month it changes, right?
Well, there's reset periods, but mostly what it's doing is picking the month, right? Are you in June oil or are you in August oil? That tends to be a pretty big determinant of the difference between different commodities funds.
Yeah. And what else are we seeing in flows into commodities? Anything? I mean, is the commodity trade over? I know you're not a strategist, but
I don't think it's over. I don't think it's over. I think it's going to take some time for the commodity trade to be over. The geopolitical risk is not going to go away anytime soon, and we see how politics have really played in the price of commodities. DBA, the agriculture fund, has been a fund where we have seen very positive flows at the beginning of the year. And then clients came to us and said, we don't like to have a K1 at the end of the year. Can you do something about it? And we created the 40-act version of that fund, which is PDBA. And we have seen very positive flows in there. So I don't think the commodity play is over. It's going to take a while for that.
That's an important point about getting the K1 and make that distinction there. Yeah. What funds do you get a K1 in and what funds do you not get a K1 in?
Correct.
Yeah, so I mean, usually they say no K1 on them in the fund name, which is the thing that you want to look for. It's important to point out that the K1 is mostly a hassle. It's not that you necessarily make less money when you get a K1, just your accountant makes a little more money because he has to do a little more work at the end of the year filling out your paperwork. But the no K1 versions of these would sort of use a little bit of a trickery would be the wrong word. They use some mechanics to get around some of the problems in the 40 Act in terms of how commodities get taxed, all totally above board. It's become how most commodity investing gets done now is in these no K1 vehicles like PDBC or PDBA.
What's amazing to me this year is to watch this debate because as an asset class, we always talked about stocks, bonds, commodities, and maybe real estate as a separate asset class, but nobody paid attention to bonds or commodities as an asset class in the last few years. And all of a sudden, instead of there is no alternative, Tina, it turns out there are alternatives.
And some of them have done well, very
well. Some of them have really done well.
Yeah.
So to me, you know, the Jack Bogle says, oh, there's mean reversion, you know, eventually. It's about time, actually. Because if you think about it, what we just saw in the last 10 years, that's weird. Not what we have now. 4-year 4% yields on a 10-year is not weird.
No, it's pretty normal.
What's happened before was weird in the last 10 years. So as painful as it is nice to see some normality. It is nice to have your mother call and say, Robert, I saw the CDs at the bank. They're offering more. I said, no, Mom, the CDs are still terrible. But even my mother noticed.
Right. Well, you put inflation into that mix, and I think that's the part that a lot of people haven't quite, even advisors I'm talking to, they're hunting for yield. They're looking at dividend funds. They're researching this stuff like crazy. But in the back of their head, they should have that voice that says, but in an 8% environment, 4% still losing me 4% real a year.
Yes.
And that's, I think, the part that a lot of folks are really rethinking their portfolio allocations because of that.
Yeah. I guess the question is, can we bring it down and still stay at 4% and finally get some, real returns on the whole thing?
Yeah.
We don't know, folks, but that's what makes it fun and interesting. And remember, there's ETFs for all of that. I'm going to have to leave it there. These are two of my best friends here, so they know a lot. I could go on for an hour on this, but we've got to stop, folks, because you got things to do. My thanks to Anna and Dave. And we're best. Dave, to stick around for these ETF Edge podcasts afterwards. He's going to give us a little take on bigger trends for the remainder of 2022. Remember, you can see all of the shows, everything, on our website, etfedge.cnbc.com. Everybody have a healthy, happy, safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.